Welcome back to Market Matters, your guide to understanding the Indian stock market.
Ever wondered why companies suddenly appear in the stock market and start offering their shares to the public? What makes them take that step, and how does the journey begin? In today's episode of Market Matters, we'll walk you through how a small idea grows into a public company and why going public is such a big milestone. Let's start at the very beginning. Imagine a young entrepreneur with a brilliant idea. Let's say to launch a premium brand of eco-friendly cotton t-shirts. The designs are fresh, the materials are top-notch, and there's passion behind the brand. But passion alone doesn't pay the bills. The founder needs money, not from banks or big investors, but usually from friends, family, or early supporters who trust the vision. These people are called angel investors, and the money they invest is known as seed funding. This early-stage investment gives the company its first push. In return, the angels receive a portion of the company in the form of shares. At this point, the company is just starting, and its worth is usually based only on the cash it holds and its future potential. As the business gains traction, maybe opens a few stores and starts generating revenue, it's time to grow. Now enters the next big player, the venture capitalist, or VC. VCs provide the next round of funding called Series A. They invest more money than angels, but they also want a bigger stake. The moment VCs step in, the company's valuation goes up. This makes the angel investors happy. Their shares are now worth more. The VC funding helps the company expand operations, maybe another factory, more staff, and bigger distribution. And with that, the startup becomes a proper business. After a few years, things really start to take off. The company wants to expand into more cities, launch new products, or scale up infrastructure. These are big plans, and they need big money. This kind of spending is known as capital expenditure, or CapEx. To fund this, the company may do three things: reinvest profits, raise more VC money, Series B, take a bank loan. This is called debt. All three combined can help meet funding needs, but each comes with its pros and cons. Debt brings interest payments. New funding means diluting ownership. As the company matures further, it might look for even bigger investments from private equity, PE firms. These firms invest large amounts in businesses that are already performing well. Unlike VCs, PE firms usually demand a seat on the board to monitor performance closely. They don't just give money, they help guide the company to the next level. This is often called Series C or D funding. PE funding helps companies grow nationwide or even prepare for global expansion. And then comes the big leap, the initial public offering, or IPO. An IPO is when a private company decides to raise money from the general public by selling shares for the first time. This step transforms the company into a publicly listed one, meaning anyone can become a part owner. But why now? Why didn't the company go public earlier? Well, going public isn't just about raising money. It's about reaching a level of maturity, having a track record, strong revenues, and trust in the brand. Only then does it make sense to invite the public to invest. So why do companies choose to go public? To raise large amounts of capital without borrowing. To expand further, maybe even globally. To provide an exit route for early investors like VCs and angels.
to build credibility and brand visibility, and sometimes just to reward loyal employees or restructure debt. But once public, the company has new responsibilities: compliance, transparency, and performance accountability to lakhs of new shareholders.
In short, a company's journey from a small startup to a public company is long, full of twists and turns, and involves multiple stages of funding. An IPO isn't the beginning. It's a milestone after years of hard work and strategy. In the next episode, we'll explore the IPO process itself, how it works, who regulates it, and what you as an investor need to know before investing in an IPO. Don't forget to like, subscribe, and share Market Matters for more insights.